Options trading strategy. Straddle. A straddle is a neutral options trading strategy that involves the simultaneous purchase or sale of both a call option and a put option for the same underlying asset with the same strike price and expiration date. The strategy is primarily a bet on volatility rather than the direction of the price movement. The long straddle, buying volatility. This is the most common form of the strategy. It is used when a trader expects a significant price move in the underlying asset, but is unsure which direction, up or down, that move will take. The setup. To execute a long straddle, you buy one at the money ATM call and buy one at the money ATM put. Underlying asset must be the same for both options. Strike price, both options must have the same strike price, K. Expiration, both options must have the same expiration date, T.
Payoff and profit potential. The goal is for the underlying asset to move far enough in either direction to offset the cost of both premiums paid. Maximum profit. Theoretically unlimited to the upside, as the stock can rise indefinitely, and very high to the downside, as the stock can fall to zero. Maximum loss. Limited to the total debit paid to enter the trade, call premium plus put premium. This occurs if the stock price equals the strike price at expiration. Upper break-even point, K plus total premium. Lower break-even point, K minus total premium.
Key mathematical relationships. The value of a long straddle at expiration can be expressed as profit over loss equals absolute value of ST minus K minus C plus P, where ST equals price of the asset at expiration, K equals strike price, C equals cost of the call option, P equals cost of the put option.
3. The role of the Greeks. Understanding how a straddle behaves requires looking at the options Greeks. Delta. A straddle starts with a delta neutral position. The positive delta of the call, plus 0.50, cancels out the negative delta of the put, minus 0.50. Vega. High sensitivity. Long straddles are long vega. They benefit from an increase in implied volatility, IV. If IV rises, the value of both options increases, even if the stock price remains stagnant. Theta, the enemy. Long straddles are short theta. Because you own two options, time decay works against you twice as fast. If the stock does not move quickly, the daily erosion of value can be significant.
4. Short straddle, selling volatility. The short straddle is the inverse of the long straddle. You sell both an ATM call and an ATM put. Market outlook, neutral or expecting low volatility. Profit potential, limited to the total premiums received. Risk, unlimited. If the stock makes a massive move in either direction, the losses can be catastrophic, as you are short gamma and short vega. Best scenario, the stock remains exactly at the strike price at expiration, allowing you to keep the entire premium.
5. Strategic timing, when to use a straddle. Traders typically use long straddles ahead of major catalysts where the outcome is binary or likely to cause a gap in price. Earnings reports, when a company is expected to report significant surprises. FDA approvals, common in biotech trading. Economic data, preceding CPI data or Federal Reserve interest rate decisions. Court rulings, major legal decisions affecting a company's valuation. Comparison, straddle versus strangle. A closely related strategy is the strangle. Strike prices. Straddle, same, at the money. Strangle, different, out of the money. Cost. Straddle, expensive, higher premiums. Strangle, cheaper, lower premiums. Movement required. Straddle, less movement to hit break even. Strangle, significant movement required. Probability of profit. Straddle, higher. Strangle, lower. Thanks for watching. Don't forget to like and subscribe to support my channel.